Alrighty. Good morning, everyone. It is Friday. It is the weekend before Christmas. Town has been wild, but thankfully where I'm at right here, traffic is pretty smooth. But today we have a great episode. We're going to be talking with Logan Bowers, not Powers. My last name is Powers. It's kind of weird, but Logan Bowers with a B. He is co-founder and chief investment officer at SOW Capital Partners. And so we're going to be talking with him about his company, and it's about real estate investment and how it changed his life and how it can help others change their lives too. So it's going to be really neat. You're going to want to stick around. So yeah, hang out. Alrighty, so before we go too far, I want to go ahead and get my presenting sponsor mentioned here. It is Chase Group Construction. They take the lead and become your one point of contact for the entire design build process. So if you're looking to build a new business or maybe to renovate a space for your business, they can handle that for you. They are a design build firm. So they design it, make your dreams come true with that, and then further the dream come true process by building it for you. And so they're all one-stop shop. I hate using one-stop shop, but they are a one-stop shop. And they have a diverse portfolio of projects that range from medical centers to popular restaurants. And they're also building some really cool stuff at the moment. A place in Youngsville that I haven't posted about yet, but you might have seen it. It's about pickleball. Yeah, so it's going to be I'm saying a lot right here, but it's going to be the pickleball, the Top Golf of pickleball. Anyway, hang out for that later this week or next week, maybe for Christmas I'll launch it. And then, multi-unit shopping centers. They built it all. Their website is chasegroupconstruction.com. Check them out. They're on Facebook, Instagram, all those places. They make really cool videos about their projects. Today we're going to be talking with Logan Bowers about real estate investment. Don't log off yet if you think this is going to be boring. This is probably going to be good, especially if you have any sort of inkling to what you're going to do with the rest of your life. If there's something that you feel that you want to change, or if you have a remote interest in real estate at all, it's going to be a good one for you. So Logan, welcome to the T Podcast.
Yeah, thank you, man. Before we jump in, I just want to reiterate the Chase Group there. I met with Chase last week, and one of the things really cool that he's doing is they have this software that they're using to map out site plans with AI. So they can get your site plan set up and put in the regulations and move it around, and it instantly changes the design. So really, really cool to conceptualize projects. So great sponsor, and they do a great job.
Well, that is a good plug right there, man.
Yeah, for sure.
I appreciate that. So he did kind of tell me about that, and I haven't seen it in action yet, but I want to. That sounds like a fascinating situation where you can just dynamically move stuff around and see it. It's really cool. But this is about you right now. So go ahead and tell us a little bit about you. I don't think you were always in real estate at all. Tell us who you are first before the real estate. Who is Logan Bowers?
Yeah, man. Great question. So born and raised in Lafayette, been here my whole life and dealing with the humidity and the mosquitoes, so went to school, just kind of did the normal thing, right? Public school, Como High. Shout out to the Spartans, right?
All right.
We were terrible at all sports, except for wrestling. We dominated there. But anyways, went to UL for a short stint. And I was didn't have a really clear path of what I wanted to do. I was always pretty sharp in school, built some really terrible habits in high school because I learned from hearing. So I could take tests without actually having to study, and I never did homework. Wow. I got to college, and college was hard, and especially I was in pre-med because I wanted to make a lot of money and I wanted to help people, and I was like, oh, doctors do this. Yeah. So did that for 3 semesters and really just did not enjoy it at all. I hated it. I hated going to school because I had no real clear path of what this would look like. I just thought that's what I wanted to do, but it wasn't really in alignment with my personality. So ended up I had a really good friend. His dad was kind of high up at Halliburton and in the fluids division. And so I was kind of like debating quitting school, and he and my mom were talking because me and, his son played soccer together. And so he was like, hey, look, like I can get Logan a job if he wants to go in the oil field. And I'm like, sign me up for that, right?
The oil field, man.
Oil field.
Yeah, easy money, supposedly.
Yeah, like every good South Louisiana boy,
Yeah,
if you don't have a degree, you go to the oil field and make six figures, right? So I did that. And in doing that, man, I got exposed to this whole new world, right? Of like young kid. I was 19 years old with all of these adults and all of these adult problems. And these guys are making fantastic money, a lot of them. And I just watched them over and over and over again. I was in the oil field for 8 years, and just story after story after story of these guys making a whole lot of money, but having very little freedom and actually having very little money, even though they were making a bunch of it. And I was like, this is interesting. And so I kind of knew then that I didn't want to do that forever, because I didn't see the path forward that wasn't working until I died offshore,
Right.
So that was kind of how I got started, was going into the oil field as a young kid and growing up fast. And, it was great. It was a really good learning experience, but I kind of knew that I didn't want to do it forever, but I had no clue what I was going to do.
So we're in the oil field. Were you a roughneck?
I was not. So I first started doing fluids. So I was in
I know you mentioned
Fouchon.
fluids. Yeah.
Yes, I was in Fouchon. We were making completion fluids, 7 and 7. And then that's right about when they had the moratorium happen. And so basically they were like, hey, we can't keep you in the fluids division. That's like 6 months. We can't keep you here, but we want to keep you at Halliburton. So they offered me another job in Slickline out of New Iberia, which is basically like a coat hanger wound up on a giant spool, and they send tools down hole and go manipulate valves and stuff, right? This point, I have no tops because I quit. I was getting paid to go to school, literally.
Right.
But I quit, lost all that. So I'm like, all right, I can't go back to school because I'm definitely not going to pay for this. I didn't like it when I was there. I'm not going to pay to go. And I was like, I have no idea what Slickline is, but I need a job. So like, sign me up. So I did that for 5 years, or about 5 years, 4.5, let's say. And then from there, I moved into well testing, which is basically mobile production. You go out there, the geologists have an idea what the well is going to produce. We would go and set up all this equipment, test the well, see how much production it had, and then let them know the results of those testing, where they could either bring it online to their production facility or manufacture a production facility to handle the volume of the well. So
I guess, like, this is not the typical entry level position at an oil field, is it?
So the basically where I was at when I first went in, it was a entry level job, but the plan was for me to go to mud school in Houston and to become a mud logger, which is like I think it's like 6 months training for mud school to become a mud logger, which was typically a non-degree position. I think they're moving towards that being a degree position now, but that was a non-degree position then. And when I went to do the slick line, they again saw I had some aptitude. I was willing to work hard. And so I was in a fast track program to become a supervisor. So I moved up pretty quickly inside the oil field world, because I had a lot of things that were a mess in my life during those times, but I always knew how to work hard. So like that was kind of the thing that always like kept me afloat.
Yeah, no, that's typically the thing, is like, if you are a hard worker, you can pretty much do whatever, but also having some smarts with that hard work gets you pretty far. Because I know people who are hard workers and they're not that smart, and they don't really move much. You know, they stay and I'm talking about specifically in the oil field, kind of harder industries. And they stay in the little position and they're happy with it, and that's where they stay for the rest of their life. And then some people that are great learners but don't really care for school all that much, they pick up stuff quick. I would like to say that maybe I'm kind of that person. School is not my favorite thing. I didn't go to college or anything like that, but I've always been interested in certain aspects of industry, whether that be media. I was never interested in the oil field. By no means, never did I want to touch that with a stick. But I appreciate those people that do. But for me, I was like always interested in like computer related tasks and industries. So I just focused on that. And so, yeah, I mean, those people that think that, oh, I don't have an education doesn't mean you can't move up.
No, like, and I've been knowing you for a while now. Like, you've always been a learner, though. And that's like kind of one of the things that I see that sets people apart is the people that are growth minded. They're typically pretty avid learners, whatever it is they're interested in. And so I was kind of like you. I used to equate like I didn't like school, so I didn't like learning, which was totally untrue. I literally listen to podcasts and learn every single day now. I'm just infatuated with learning and growing, but it's about stuff that I'm interested in.
Right.
And I just wasn't interested in the stuff that school was teaching me, you know?
Yeah. It's like books. Like, so I wish I could say that I was a person that would sit in a coffee shop and read an entire book in a day.
Yeah.
I'm going to tell you, I have never read a book through and through.
Really?
No, sir. I lose interest in it.
Yep.
I drift off in my mind. I start imagining things that the story doesn't even have anything pertaining to it. But magazine articles, small chunks of information, I would gain from that.
Okay.
So to your point, I equate podcasts as a magazine.
Yep.
You know, they're talking about a very specific topic, and that podcast as a whole may have episodes that I don't find interesting, but they talk about it. So there's certain things that I learned from podcasts and YouTube videos and shorter bits of written information. That probably explains why my grammar was so bad whenever I first started developing Lafayette, because I hated having to sit there and try to read something. So I never grasped what appropriate grammar would look like. People say I would write like I talk.
Yeah, me, dude, I was terrible at that too.
Yeah.
It's like, and it's one of my favorite things is actually to write like written marketing emails. Now it's like one of my favorite things, and we get a lot of good feedback on those. But like, I literally spell words so bad sometimes. My iPhone doesn't even give me an autocorrect option because it's spelt so poorly. I have to like try to spell it closer to even get an autocorrect option. So I'm in the same boat, dude.
Yeah, I do the same thing. But thankfully, I've learned, with like you said, the growth and learning mind. I never think that I have that, but I guess I somewhat do. I realized early on, after being told that I should fire my writer, because I'm the only person that's writing, but I should fire that person. I'm like, great. That means I should quit. So I didn't want to quit. So I said, how do I improve my writing? So what I would start doing is, as I was writing, I would try to like visualize where a comma should be, because I struggled where comma should be, and I still somewhat do. There's sometimes I'm like, oh my God,
me too.
This is confusing. So what I'll do is, now with the access to the internet, we really can learn anything on the spot. So I would stop and I'd be like, okay, let me just excuse me, let me just Google, does a comma go after this word in this context? And I would basically copy my sentence. And this is before AI really picked up.
Right.
So I'd drop it in and it would give me options. I'm like, okay. So like a comma before and. So if you have a series of objects that you're listing in a obviously a series, is there a comma after the last word before the and? Some people say no. Some people say yes. I started using a comma after the last word before the and. Mm-hmm. I just do now, and it just makes sense.
I think the technical term for that, Ben, is an Oxford comma.
Oh, that's right. See, I've heard that term. Yeah. I use an Oxford comma. There you go.
You're supposed to, if you're talking about in a series, you are supposed to have that comma there.
Yeah. So there's some things, but there's some things that I've had to learn through grammar, and then I've thankfully haven't been told to fire my writer in a long time.
Yeah.
And with the advent of AI, I now can just take all my writing, improve it the best way I can before I put it into AI. So I use Grammarly and I use ChatGPT,
yep.
both of those interchangeably. In fact, I'll use both of them to correct themselves, because AI will sometimes get something wrong. So I'll cross-check it with another one. And
okay.
What's good about those things is, like, I can ask it, why did you put that there? And then we're kind of on a tangent here. We'll get to the juicy stuff in a second. But I will ask it, why did you put a comma there? And it would explain, like, oh, this, and that. I'm like, okay, cool. But anyway, so yeah, long story short, growth-minded, learning and being able to adapt and whatnot.
It's great. This is great. I love this kind of stuff. I love when podcasts do this, right? It's like, so if you're watching this and you're not using ChatGPT or Grammarly or AI, like, it is a huge, powerful tool. And I also want to make this point. It's like, we're not bashing education, guys. Sometimes,
definitely, yes.
I bash education. Sometimes I do. I will admit that. And if you're going for something very specific, it's very necessary. But our parents, the boomers, right, like loved them, but they didn't have access to information like we do.
Oh, no, yeah.
So going to a university and getting a formal education and all those things were super valuable to them because it wasn't, now we have information everywhere. You can literally get on YouTube and learn anything you ever wanted. So now we're not in the information race. We're in the, you just got better at writing by trying. We're in the application race.
Right.
It's like who can actually do the things in real time.
Yep.
To get better at them, like that's the game we're playing now. It's not a knowledge game anymore. It's a who can apply this stuff.
Yeah, I mean, literally everything that you want to know is accessible. It just takes the execution and applying that specific information or knowledge to what you want to do. So, like, I started an Etsy store in 2022, and I started learning how to not design for products. I could design for products, but like how to list them, like what's the correct verbiage to sell, like how do you convert? Because that's a hard thing to get people to want to convert. Yes. And I'm like, okay, well, how come this store that's very similar to mine is doing so well, but I have the exact same style of product, but I'm not selling? So what I would do is I would compare my listing to their listing. I'm like, okay, what about this is selling? And so I would, learn that, and I would watch these YouTube gurus about Etsy and this and that. I'm like, okay, so there's certain verbiage that changes. It's like psychology behind. And so, yeah, that's another application of, you can always learn to do something new that you haven't really put yourself in through. So like I've always wanted to have a retail store, but it's kind of, it's a daunting thing to think about because like, first of all, how do you inventory? Like where do you get your supply from and stuff like that? But yeah, so we're at about 16 minutes. I want to go ahead and start to transition into your company and talking about that because I think we kind of set up a path in here to kind of segue into that. But first, I do have a sponsor that I'll mention. It is the Music Academy of Acadiana. So if you're looking to learn music, check them out. They're Acadiana's top school for music lessons, top music school. They're founded locally by UL Music School graduate Tim Benson. Great local guy, great company. They teach all students of all ages and styles and all types of instruments, like literally pretty much any instrument you can think of, they'll teach it. Also, your voice is an instrument. They'll help you improve it. And if you're not the front kind of guy or girl and you want to be behind the scenes, BTS, they teach audio production as well. So you can help music sound good and not have to actually make the music, but you're making the music in a... Anyway, they help with all facets of music and a great school. They've been on American Idol and The Voice with some of their talent. Their goal is to make music lessons fun, educational, and to help foster the next generation of musicians and creative thinkers. You've heard me say that before because it's true. Their website is musicacademyacadiana.com. Check them out. They're on Facebook, Instagram, all those places. The owner, Tim Benson, he's in an emo cover band called The Criers. Check that out too. They tour locally throughout Acadiana, probably a little bit farther out than that, but they sound just like all the music you would listen to in your car in high school in the early 2000s. So check them out. Okay, so your company, SOW Capital Partners.
Yes.
All right, so what?
We have lots of so jokes, by the way.
I bet. So, how did you go from, oil field, all this good stuff that we were talking about earlier, and into real estate? Because that feels like a very weird pivot.
Super weird. And it was not done on my own accord.
Okay.
So basically I was... went from the slickline job at Halliburton. I had a really good friend who was working for this smaller company called Setco Energy Services, and he invited me to, and he was telling me about it. And at the time, I'm at Halliburton. We have like 95,000 employees. This company has like 1,000 employees. I'm like, dude, why would I go work for this little company? Well, anyways, I meet one of his friends at the company at a party, at a mutual friend's birthday party, and me and him kind of hit it off. And so he was like, hey, man, like, you don't have a degree. He's like, if you want to stop working offshore, you probably need to think about going to a smaller company because Halliburton is going to have you offshore for a long time if you don't have a degree. And I'm like, okay, that makes a lot of sense. He's like, come be a big fish in a small pond versus a tiny fish in the ocean. I'm like, okay. So I ended up moving over there, and that guy's name is Brandon, and he became one of my best friends and one of the most influential people in my life. So I move over there. I spent a year in the field kind of learning that business. And then I moved into the office into a operations manager role. And so through that time period, he was kind of, at the time I'm like 25 years old, right? And he's kind of pouring into me, and he starts asking me questions about retirement and investing, and starts asking me about real estate. And I'm like, dude, like, I just want to bow hunt and drink beer and play golf, like, and fish. Like, I don't care about retirement. Like, I'm 25 years old, you know?
Yeah.
Well, that kind of like starts affecting me, and I start thinking about these things. And so at the end of 2015, me and Hillary got married. So we get married and we start going to church, and end up giving my life to Christ, which was a huge moment for me and kind of prepared me for the craziest year of my life, which was 2016. And so in that year, I'm like, all right, I'm interested enough, Brandon, to hear what you have to say, because he was one of the people that like led me to Christ, like by asking me really, really challenging questions. And he gave me this book called Rich Dad Poor Dad. So I read this book and I'm like, oh my God, I have no assets. I have all liabilities. All the things that I think that I own that are worth something are costing me money every month, and I don't really have anything that I own. So from that moment, I am like hell bent now to buy assets. And so through that, one of the things that was very impactful for me was just trying to figure out what I could buy, right? Because at that time I was like, I only have so much money. I got to go find something that I can buy with the money that I have, right? Even though the book told me to use other people's money, I was like, no, I need to figure out how to buy something with the money that I have. Well, I didn't have enough time to think about that or pull the trigger on anything, because a month later, we found out we were pregnant with our first son. Mm-hmm. And then a week later, me and Brandon both got let go from our jobs.
Oh, wow.
So we went from 1,200 employees in 2014 down to 200 by April of 2016, because oil prices crashed in 15.
Yep.
And on the day we got let go, they had 200 people left in the company. They let 50 go. So we made it really deep in, and we had talked about starting businesses and just never had the courage to leave. And then at some point we're just like, hey, we're not going to quit. We're going to wait for them to fire us so we can get our settlement check, right? Yeah. So we can get our severance package, right? So that all worked out. We got our severance package, and I remember feeling very sorry for myself, like, because work was always the thing that was what I was good at. I was like, I could work hard, right? Yeah. So I felt sorry for myself for a few weeks, and then I finally one day I was sitting on the sofa in my boxers, watching ESPN First Take, filling out applications to go back to Halliburton, dude.
Oh, wow.
So I've been miserable as an employee. I'm like, I'm going to do what I know. And so many times when we get in life, we have things that are uncertain, or we get punched in the mouth, like we go back to what we know, right? Because it's comfortable, even though it's probably not fun. I was in that moment. I was like, I am not going back into the same place that I hated being. Like, this is literally the definition of insanity, is doing the same thing, expecting a different result.
Right.
I called Brandon up and said, hey, let's do the real estate thing. So that was before I bought anything. That was before I even had an LLC created. But I tell people, like, that was the day that I became a real estate investor, is when I decided that I was going to do something different. It was that day in my house, this was like June of 2016.
Okay.
Yeah. So from there, me and Brandon start looking for properties, and we start, all right, we're going to flip houses and buy rentals with the profits from those houses. So that's what we did. We started flipping houses, and the very first house we get, dude, this is kind of, I'm telling you this because it's important for like the whole entire business model, is the very first house. Okay. We get this house. It's on Daniel Drive in Lafayette. Okay. Little bitty house, 3-bedroom, 2-bath. We're buying it from another investor, and the purchase price was $100,000 and needed about $20,000 worth of work. So we're all in for $120,000. He has 30 grand. I have 30 grand. So we're going to put 60 grand down. So we're going to put half the money down. His credit score is over 800. Mine's in the high 7s. And we go where everybody goes to get money, to the bank.
Yeah.
We go in there. We're like, all right, we got this great deal. We've been searching for like 2 months. Literally took us 2 months to find the first house. We've been searching for 2 months. We got this great house. Like, we want to buy it. And they're like, that's awesome, but how are you going to pay us back the loan? And we're like, dude, look at our credit scores. We pay back everything in our whole lives. It's like, yeah, but you guys don't have enough income. Like, we were making, double, 6 figures and our wives were making respectively $30,000 and $45,000 a year. But our lifestyle was like, 150, 200 grand a year kind of lifestyles, but we had $30,000 and $40,000 incomes, right? Because they're like, you guys don't have jobs. Your wife have jobs and they can't even pay your own bills. So like, how are you guys going to do this? Like, how are you going to pay us back? Which was a fair question, right? But at the time, I thought they were crazy because we're putting half the money down. So their risk is basically nothing. Like we're 50% of the loan to value, much less the actual value of the house, because it'd be worth like 155, 160 when we were done. So anyways, we go to all these banks. They're like, no. And finally our mentor, who at the time, Mr. Nate Moore, go to Nate.
Shout out to Nate
Moore. Yeah, we go to Nate and Nate's like, hey, he's like, why don't you just ask somebody to borrow the money? I'm like, what you mean? He's like, yeah, just go ask someone to borrow the money. Like a person. I'm like, people loan money to other people for business? Mm-hmm. And he was like, yes. Like, you read Rich Dad Poor Dad? I'm like, yeah. You know the other people's money he was talking about? Like, this is it. So that is when it like clicked for me of like how to apply the things in that book. And so we went around, we started asking people for money, and it didn't take us very long. Thankfully, the real estate agent that we were working with, she actually ran a hard money lending business, so a loan business for a really wealthy guy out in New Iberia. And she was like, oh yeah, like we'll loan you guys the money for it. And she was there the whole time watching us like flounder, and she just was waiting for us to ask her because she's not like the promoter type where she's gonna like try to cram it down your throat. So it just wasn't her style. Yeah. But as soon as we asked, she's like, oh yeah, like I'll do the loan. I'm like, oh, that was easy. And so then we learned how to do it without the banks. And so we literally started raising money for all of our deals after that. So we would go and we would buy them all with other people's money. And we had, we put mortgages on it where they were safe and secure. And we were buying these properties at huge discounts. And so we would take their money, we would pay them back a return that was better than they could get at the bank or better than the CD, a lot of times even better than the stock market. And it was a secure asset in a city that they knew. They were all local people. And we would pay them back and go put bank financing on it when we were done. And keep them as rentals. The ones that we keep, a lot of them we would just flip and sell though and take the profits out. So that's kind of how we got started. I know that was a lot, but that's how I got into real estate. That was kind of the story of how we got into the game.
Wow. Okay, so I'm pretty familiar with a lot of what you had just said. Yep. That's typically the beginning story of a lot of these stories here. But like, using other people's money, that just seems like such a fascinating concept, especially if it's not the bank. So whenever you would get a property and you would renovate it, like you would have to find a tenant, correct? Like, would you lease it or resell it?
Both. If we were going to resell it, we would typically go and find the tenant and place them, and then go to the bank with the tenant already established, where they could see how much money we were getting in rent with a signed lease, and then they would refinance it for us. Or if we were going to sell it, we would just list it, put it on the market, and cut it loose and take the profit and pay the investor back.
Yeah. So whenever you started making a profit from that first property, what did you guys do after that point? Like, you obviously you would replicate, but you got this first property, you closed on it, you got a person living there, you're making profit. Like, what do you do now from that point?
So it was very powerful and very empowering, because I learned that you can make money with influence. You always hear you have to have money to make money, or you have to have time to make money. But the truth is that the people that I know that make the most money they're limited by their own resources, and we're all limited by the same amount of time. The people that make the most amount of money, they do it using influence. So influence is the currency of our generation. Influence is also the currency of business, right? So I learned a very powerful concept that currency of business is influence. So I was influencing one person, which is the person giving me the money. I was influencing a seller and then a buyer. And then by me putting all those parties together, I can make money by doing that, by allowing each one of them to get what they wanted, right? And I'm just connecting the dots, right? So it's like, all right, I'm making money with influence. This is infinitely scalable because I just have to get better at influence, right? So I couldn't articulate it that well then, but that was the lesson that I was learning. And so we started flipping more houses. So we just said, all right, if one is good, then 10 is better, right? It's the default, right? How much more do you want? More. It's
Right. Yeah.
So that's the mode we were in. We were also just trying to pay our bills, dude. So we were just doing everything we could to make money. And so we started flipping more houses and buying more rentals. And so that kind of built up to a certain point, but the income was it was not very stable because single family rentals don't make a lot of cash flow. Like you'll hear all the gurus selling you the passive investing dreams, but like one, it's not very passive. And two, you don't make a ton of money on a single family rental when you have a lot of leverage on it. Like they just don't cash flow that much. So you still need active income, which for most people, they either have another job or they're actively investing another way.
Yeah.
Right. So we did that for a while. Brandon ended up going back into the oil field and got a job as a salesperson, which we were both in operations before, wrong positions. He went back, got a sales job, just had that stable income. I ended up getting my real estate license because we were doing a bunch of transactions. I'm like, this makes sense for me to get this. And I didn't want to like leave real estate. I was like, no, this is what I want to do. And so whenever he went back and got the job and then I started selling houses, that kind of took us both apart and on tangents. And we kind of stalled out at like 22 doors. So we had 22 rentals, rental doors. And we kind of stopped flipping houses because we were so busy with our active stuff. And so that's kind of where we stopped growing the portfolio and then we kind of reassessed. So in that, we ended up selling all of those except for 2 doors because we were like, hey, this is not really what we want to do. Brandon was like, hey, I don't see a bunch of value in these houses. I was getting a bunch of tax benefit from them, so I liked having them, but I was okay selling them. And then in 2021 is really when I started making the shift to doing bigger deals, more multifamily, and really getting into because that's what I really wanted to do because I understood that the scale that you could have in multifamily was much more powerful. And for those people that are listening to this, and even maybe for your own knowledge, Ben, it's like, are you familiar with how single families are valued versus commercial properties?
Absolutely not.
Okay. So single families are valued based off of sold comps, right? So let's say me, you, and Jim here, right? Our invisible man all have the same house on 123 Main Street, right? We live on the same neighborhood. We each bought a DSLD house with the exact same floor plan. Okay. You're renting yours out for $2,000 a month. I'm renting out mine for $1,700 a month, and he's renting his out for $1,500 a month. When we go to sell those properties, guess how much we're going to sell them for? Whatever the neighbor's house sold for, right? So if the neighbor's house sold for $200,000, all of our houses are worth $200,000. Yeah. Right.
Well, so I'm familiar with that aspect of real estate.
So in commercial real estate is valued off of net operating income.
Okay.
So how much, essentially, before debt service, how much profit are you making? How much is the cash flow stream of this asset? So if that was an apartment complex that you had and you had 100 doors and they were all rented out for $2,000 and mine were $1,700 and his were $1,500, you would get way more money than me and I would get more money than Jim. So in commercial real estate, it's about the cash flow stream. So in single families, I have to wait for the market to get better. No matter how good I operate, I just have to wait. In commercial real estate, I can buy an asset, I can increase the cash flow stream on day one, and then on day two, it's worth more. So the compounding cycle is much faster when you can find properties where you can add income to them or decrease expenses. So you can grow much faster in commercial because you don't have to wait for the market to improve the value, if that makes sense.
Yeah, no, I did not realize that that's how that would work. I just thought that real estate in a very simple form was just how much that property is in the market.
Yeah.
Whether it be commercial or residential.
And there are market dynamics that affect the commercial pricing, like interest rates, and like there are outside factors.
Yeah.
But you can still make a property. This is the interesting part. In a market that's going down, so the valuations are going down in commercial, if you increase the cash flow stream enough, you can literally outpace the drop in the market if you can add enough income to that property, right? Whereas in residential, if the market's going down, there's nothing you can do.
Yeah.
It's just going to sell for whatever everything else sells for.
So essentially, you're saying raise the rent.
Yeah. Yep.
Okay.
Or optimize expenses.
Okay.
So in single family houses, you pay a manager typically. Some people self-manage. I think that's a terrible idea for everybody out there doing that or thinking about getting the real estate. Self-managing is not a fun job. So self-managing, or you typically pay a property manager 10%, right? Is pretty average, right?
Right.
So if you have a portfolio of 50 single family houses, or let's go more. Let's do 100. If you have 100, you're going to pay 10% because those houses are all spread out. They're all over. Well, in commercial real estate, you can pay a full-time manager, right? That stays at that property. So you can drive the fees down because you can pay one person to manage all of those doors that are in one location. So you get some economies of scale. So I might be paying 10% from my single family portfolio where I might be paying like 6 or 7%. Mm-hmm. So that's just straight profit that I get to take in. And in commercial real estate, it's applied against a cap rate. So you get the money you save is actually like compounded, not just dollar in, dollar out.
Son, man, like the amount of words, real estate jargon that you're using is so wild because like your business so well, the industry so well that whenever you say certain things, I'm like, wait, what is cap rate? Like, what is all this stuff? Like, so fascinating. It really is.
Yeah. So the long story short on that, the TLDR, right, is that commercial real estate compounds faster than single families. Right. Like that's okay. That's the premise that I kind of knew. And I was like, all right, so I want to focus on this. So that's when I started buying. I bought an apartment complex, or I bought a mobile home park, bought an apartment complex, and kind of started moving into the commercial space. And through that, everyone's felt the rates increase in 2022, right? So through that, it really made the commercial market tough because sellers still wanted COVID prices, right? Because real estate was through the roof. Sellers still wanted COVID prices, but the debt service went from 4% loans to 8% loans. Mm-hmm. So the numbers wouldn't work. So that's when I kind of had a little shift and got into private lending, which was a really interesting business model where I became the lender that I used to borrow money from, right?
Yeah.
So I started then loaning money out and taking other investors and helping them loan their money out to other investors that were fixing and flipping houses, right? So I started servicing the person that I used to be, which is kind of cool, right?
Wow. So yeah, you made several shifts.
I have, and so I've it's motored and grown, and like I'm 8 years in, and I'm in the real estate, and I feel like I've just like found what I'm like really geared to do. And you only learn that no college professor could have taught me that, no textbook, no YouTube video. Like you learn by doing. It's the fastest teacher. And so I've been through these iterations, and when I started doing the private loans, I'm like, oh. This is the greatest way to make money in real estate is that somebody else deals with the tenants and the toilets and the renovations. And I just sit back, and if I did a good job on the front side, I can make money really passively. Right?
Right.
So that's kind of our business model now where we're at is like, what we do is we don't do the short-term loans anymore, but we partner with very, very institutional grade operators, people that have thousands of mobile home park pads, people that have thousands of apartment doors, and they're the ones that are dealing with the tenants and the toilets and all the operations. And we simply pile investor capital into a company, and then that company invests into their deal as a limited partner. So we take people and we say, hey, Ben, you want to invest in this deal? They say yes. Say, all right, you write us a check into this fund, and then the fund invests into highly vetted deals. We spend most of our time building relationships with operators all over the country, figuring out which ones are full of it and which ones are not. Because every pitch deck and everybody's presentation looks great, right?
Right.
What's the best sales pitch? The last one you heard, right? Because it's like, but if you don't understand how to get into the weeds of all those terms I just used, the cap rates and all, if you can't really dial that in as a person who's wanting to invest passively, you just kind of take a shot in the dark.
Right.
So what we do is we go in and we find very select operators. We spend months with them, learning their business, verifying their track record, just like really doing high due diligence on them. And then we take their deals that are highly vetted to retail investors who want to just earn a passive income stream from these real estate deals. That's not the guru passive, is truly passive. Like they write the check and then they just get money back, right? So that is what So Capital Partners is, stewardship of wealth. We help people steward what God has given them and entrusted them with into very sophisticated commercial real estate deals that they don't have to be an expert on because we are.
Wow, man, the path that you took is wild. It really
crazy,
is.
huh?
So from residential to commercial to being the person that people come to for money.
Yes, yeah.
Okay. I mean, it seems like that would be the natural progression of how things would work, but it just, I mean, in such a short time, I feel like you shifted.
Yeah, it was partly because I'm a squirrel. You're right. So I finally have a new business partner now, and I finally have someone who is me and Brandon didn't have complementary skill sets. We had the same. So we were like, we're the hunters, right? We go and hunt and we bring the things in, but like no one was there to clean up our messes. So my current business partner, that partner in So Capital, Spencer Artigo, me and Spencer are very complementary. He's an engineer by degree. And so he is a loop closer. He hates having things that are undone. So he does two things. He closes some of the loops, right?
Yep.
But he also stops me from opening a bunch of new ones that don't need to happen. So part of that, Ben, is progress, but part of that is just my lack of focus over the years.
Yeah,
and
being a squirrel, yeah.
Being a squirrel. But now I'm like, all right, this is what I really, really enjoy doing because I get to use my skill sets, which I'm really good at negotiating. I'm really good on the front side of like analyzing the risk of deals. But once we get the deal closed, I'm not interested in them anymore. I'm like, all right, this is boring now. What's next? When the model that we run, that's what we get to do. We do all the front side work, and then we get to help people place their capital in. And then once we do that, then that's it. Like we sit back and hopefully we make good picks. And if not, then we get that. But if we did, then we also get that. But it's all done passively. After we make that first shot, we're done. We're along for the ride, essentially.
Okay. So now you bring up a good point of, hopefully you make a good pick.
Yep.
So in the perfect world, you make picks that generate, money, and then you're good. You didn't make a bad decision, but what happens when you think you're picking well and something happens, something goes sour? Like obviously you probably have had an example like that already happen.
Oh yeah.
Like how do you deal with that? And what is your path after that? Like how do you deal with picking picking a bad investment essentially?
Great question. The short answer is you're not going to always pick winners. Like you're going to pick some losers. And I used to have the perception that I could always pick the winners. And so it was very demoralizing and also with like a very self-worth crushing when you put all that weight that you're the perfect picker. Because the truth is no one is. Like everyone picks dogs sometimes on investments and some of them just not going to go as planned. So what I've learned is to mitigate those downsides, right? And the first way, the core way that we mitigate downsides is we don't chase deals. We chase partners.
Okay.
Okay. Because really bad partners can bring really great deals, but really good partners very rarely bring really bad deals.
Okay.
Okay. So that's the first thing that we do that's different than kind of the market is everyone chases real estate deals, but a really bad partner can bring you a really great deal. And a really bad partner can ruin the absolute best deal. The reverse is true. A really good partner can salvage a deal that would be super south. So that's the first way that we mitigate that risk. And we do that. We go to these operators and we go and vet them and look at their track record and say, hey, have you ever lost money? Right? That's like one of the core things that we do in the beginning is like, have you ever lost money? Yes or no, right? We ideally want that to be no, because there's a lot of them out there that have no, but some of them say yes. It's like, okay, can you tell me about that? And they do. It's like, all right, can we talk to some of the investors that invested with you when that happened? Because you want to know what that experience is like. So I have not, knocking on this table, lost an investor dollar to date. I have lost my own money in several deals where it went south for the investors and I wrote a check to make up the difference. So I have personally lost money in some of these deals, but we have returned all of our investor capital so far. But the first way is picking the right partners. The second way is structuring the deals properly, where we are in a preference position, right? Where we have some level of protection in the deals. And I'm not gonna get into all the details of how we do that, but how you structure a deal matters, right? So that structuring and how you're positioned in what's called the capital stack, basically the waterfall of how everybody gets paid out, knowing where to be in that capital stack, depending on the person's risk profile, is a core way to make sure that your capital is protected. And then there's some deals that are just highly risky, and we just disclose that up front, like, hey, this is highly risky. We still like it. We still think there's opportunity, but just know you can lose all your money here, right? So addressing those things on the front side and making people aware of the risk it's way less painful when they're aware of the risk and it happens versus you selling them something that it's not, and then they experience risk that they didn't know was there. That's when things are bad, is when the expectations are off. I've had people, dude, that were in bad deals that the expectations were set properly and they were happy as can be at the end of it, just getting their money back out. And I've had other deals where we got them above average returns, but the projections were a little bit higher than that and they were disappointed. So it's like, I'll give you an example, like a deal we made an investor 20%, dude, 20%, but we had projected 25%. They made 20%, which is almost double the stock market average.
And they were upset.
And they were upset because we had projected 25%, because like there's just things that happen in some of these deals. This is one of the riskier ones. And we just came in a little bit below what our projections were. Whereas I've had some deals where they were supposed to make 10% and they made 0%. But they got their principal out, but they were okay because I set expectations like, hey, you can lose all of this. You can lose principal, right? You can lose the money you put into this.
Yeah.
And they didn't. So they're like, hey, I don't care about the return. I just got my money back out. It's like, all right, great. Because I let them know like, hey, you can lose this. So I'm much more clear now when I sit down with investors of like, hey, this is the risk you're taking. And then it's almost always positive.
Dude. It's such a crazy world of business, man. I never would have thought that there was so much. I mean, I knew that there was a lot that goes into real estate and different folds of where you can be at, but my interest in real estate is so minimal. Like, I think it would be cool to own, like, I'll just being, for sake of conversation, I think it would be cool to own like a condo.
Yep.
Like a condo building on the beach.
Yep.
I think for me, it's romantic.
It is romantic.
That's what that is.
100%.
And so I think it'd be cool to own a condo on the beach, but what's not cool for me is all of the operation and the headache of trying to figure out how to maintain a property like that. And how do I make money and how do I not lose money? Like all of that part gives me this weird, like, oh my God, like I just want to crawl into a crawfish hole and hide.
It's the most common thing that I experienced, because we used to do some coaching. We don't do that anymore. We just basically coach people for free, help them like analyze deals and look at what they're like, just help them work through the process. And here's the question that I ask people. They're like, I want to be an active real estate investor. I'm like, okay. It's like, why? I love real estate. I'm like, okay. If you were making $50,000 a month from an income stream and you had to do nothing for it, would you still be interested in real estate? And if they're honest with themselves, almost everyone says no. So I'm like, okay, you don't actually love real estate. I don't love real estate. I love the benefits of real estate.
Right. I mean, I think everybody would love the benefits of the real estate.
That's right. So it's like the benefits are what you're after. Well, what I discovered was that I can get the benefits by going to more sophisticated deals and just doing a small portion of it versus being the guy that owns all the condo by himself, but I own all the jobs. It's like, we help our investors get into bigger deals that they can never get into on their own because they don't have the experience or the capital. And we get to own a small piece of these really big deals. And, it's also sexy to say that you own A-class apartment complex in Dallas, right?
Yeah.
I own a piece of a 300-door unit in Dallas. Like, that's what we help people do, right? Is own that without the tenants in the toilets and like that headache.
Okay. So for me trying to dumb this down for myself, because this is how I think. So the stock market, I'm not the most knowledgeable in the stock market. I have lost a significant amount of money in the stock market in the past year. There was a company called Waiter that turned into ASAP.
Yeah, and it left the market ASAP.
Oh, they went to zero pretty ASAP. And I had several thousands of dollars into that company after 2020 because they were growing, and that was because of the pandemic.
Yep.
And I thought, ooh, let me ride this. And I had a little bit of money in the stock, and I basically, when I say stock market, like retail stock market, like if you're familiar with Robinhood, the app, that's what I would use. So I go in there and I drop a little money here and there, and then for a while, I had. My portfolio was very small. And then 2020 happened. And then all of a sudden I started seeing things change. And I said, okay, I got my money back here. If I take this and put it here, that's growing. Maybe I can ride that.
Yep.
I did the most rookiest mistake is I would, sell whenever I shouldn't sell, and I would buy when I shouldn't buy, and I was making very emotional like grabs at thing and not strategic, not looking at actual numbers or anything like that.
Join the club.
And so so basically what I'm getting at is it from what it sounds like to me, with what you just said about owning a small piece of a larger property that you do not have to control and clean the toilets and manage it. It sounds like what you've created is pretty much a version of a stock market where investors say, hey, I have a little bit of money. I would like to come to you and put it towards an investment.
Yep.
And see what happens.
Yep. Are you familiar with a REIT?
Nope.
Okay, a REIT is a real estate investment trust.
Okay.
And so most people that buy stocks are familiar with REITs because you can buy shares of a real estate investment trust on the market through the exchanges like Fidelity, and you go into these accounts and you can have access to these REIT products, right? And they're publicly traded. So what we do is basically like a private real estate investment trust. We're like a private offering for that. We have less fees. Like there's not as many middlemen in our deals. And so we just have private offerings that are very much like a stock market. Some of the deals are more like mutual funds where you're buying into a group of properties, and some of them are more like stocks where you're buying an individual asset. But it's very much like that. I like to say that we're like financial advisors, but just for alternative assets, just for real estate deals.
Okay.
Right. Wow. We're not financial advisors, and we do not give financial advice. We just can talk about our own offerings. But we do follow compliance with the SEC and, fit into some of their guidelines. So all of our stuff is regulated by the SEC and, fancy lawyers and big checks to them and all that jazz, but they're all private offerings. So you can't go and learn about these things you can't go buy them on your Fidelity account,
Okay.
But it operates very similarly.
Yeah, that's it's what it sounded like. So let's say someone like myself who is more of a real estate retail investor by just using Robinhood app. But let's say I hear about you and I wanted to say, hey, I got $1,000.
Yep.
I don't know if that's a lot or a little for what this is, but I'll say, I have $1,000. I'd like to put it towards what you're doing, and I trust what you're doing.
Yep.
What does that look like for me? So let's say I give you $1,000. What can I expect that to do?
Well, if I go to the casino with it, we can double it right away, Ben.
Exactly. Or lose it all the way.
No, that was a joke. But no, first thing we do is we sit down with people and we find out what they're trying to accomplish.
Okay.
Right? Because the investment only matters based on where you're trying to go. A lot of times we get people that come in and say, hey, I just want to, I want to make an investment. I'm like, okay, well, what are you trying to accomplish? They're like, I don't know. It was like, that's like saying, I want to go on vacation. And you're like, hey, Logan, plan me a vacation. I'm like, all right, Ben. Well, like, where do you want to go? Like, I don't know. I'm like, well, man, I can't tell you. And you're like, I need the directions. I'm like, well, Ben, you haven't told me if you want to go, like, you want to go to the beach, you want to go to the mountains. Like, let's figure out what the destination is.
Okay.
And then we can build the plan to get there. So the first thing we do is kind of map out, where are we going? What are you trying to accomplish with the investment? And then we look at the specific offerings that will get them there based on what their time horizon is and what their appetite for risk is. So in our higher risk deals, that money can double in 3 years, right? Potentially. In our low risk deals, they're going to get 8% and, getting a check every month, stable cash flow, but they're not going to have any principal growth, so that $1,000 will stay $1,000 forever, but you'll get, a check every month, for 8% yearly. So it greatly depends. Our returns will range from 8 all the way up to in the 30s, depending on the deals that we do. And that's strictly dependent upon the person's risk tolerance.
Oh, wow. Okay. So that's a lot to chew on.
Yeah.
For sure. Yeah. I mean, some of it feels super safe. Like the 8%, you said the principal wouldn't grow that much, but they would get a check. So
they would. It's a debt product. So in that case, we're investing on the bottom of the capital stack, right? So we're the lenders, and we have a debt fund that we're the lenders, right? So like the debt fund, not Logan. The debt fund is the lender, so they're loaning out the money. So we're first to get paid. Like we're being a private bank essentially. So in that we're taking the lowest amount of risk, but we get paid first. So that's why, and the borrowers are paying us monthly. So then that return flows down to the investor, and the investor's getting paid monthly, right? Now, again, the principal's not going to grow, but chance of losing it, super, super low, right? Of losing any principal. And the chance that you get paid out that return is very, very high, because we have years of this fund paying out every month, right? So that's on the lower end. That's more for the people that are trying to preserve capital. Like people that are like, hey, I got some money, I got it in a CD, right? And I'm willing to take a little bit more risk than a CD, or a money market account, because it is more risk, but very, very little. It's very, very safe deals. And the yield is almost double in most cases. So that's like hey, I got money and I don't want to lose it people, right?
Yeah.
But it's also people that want to turn on income. So people that like, hey, I have an income need. I want to get income now. Because they're hybrid deals, but real estate is very much like the market in this case. Is like you can either optimize for income or you can optimize for growth, right? If you want growth, you buy Apple. If you want income, you buy a utility stock that pays you a dividend every quarter, right? Real estate's kind of the same way. As like you can get income and growth in those middle investments that kind of have some growth and some income, but they're not going to be great at either one, really. So I kind of encourage people to be on, instead of saying, hey, I'm going to put $200,000 in this hybrid fund, I would encourage them like, hey, let's put $100,000 in the growth fund and $100,000 in the safe fund, and now you're going to get a more specialized tool to get that job of diversification. So investing in more deals versus investing in a deal that tries to do everything,
Yeah. Okay. Wow, man, there is so much here that literally just scratching the surface on what you guys do. We are at almost an hour already. So in a nutshell, SOW Capital, do you guys have a very strict, like, who you work with? Like, is it only, like, what's your ideal client?
Good question. So if you said, hey, Logan, I have $1,000, I would say, okay, Ben, like, let's go and put that somewhere else and grow it, because our minimum investment is typically $100,000.
Okay.
Right. So that's for most of our deals, $100,000. And even the ones that are a little bit less, everyone has to be accredited. Right. So
Got it.
Currently we only take accredited investors. What, are you familiar with that term?
Yeah. So I have business partners, yes. And so I know that accredited investors are people who make, if I can remember this correctly, $250,000 annually, like in income, or have is it $1 million in investments?
$1 million in net worth?
Yes.
Excluding their primary residence.
Correct. Yeah.
Yep. So that's what an accredited investor is. So that is who we typically deal with. We do have some funds that will come up in the future that we may be able to take non-accredited, but we typically, minimum is $100,000, and we typically deal with accredited investors for two reasons. One is those accredited investors are typically going to, they're going to be more familiar with the risk and more familiar with the deals. And secondly, they typically have a lot more money than they're investing. And that produces just a better experience for them and for us. And the lower we start going with the investment amounts, people want to be in deals. They especially want to be in growth deals, and we have those, so they're very attractive. But I don't want somebody giving me their last $25,000, dude. Like, It's not they're not going to sleep well at night, and then I'm not going to sleep well at night, because I know that they need this money. And the deals that we go into are usually, the money's usually locked up for 4 to 6 years, right? We have some that are shorter time frames, less than a year, but most of our stuff is 4 to 6 years. So I got to be very confident that they're not going to be calling me after year one and saying, hey, I need this 25 grand back. So setting that threshold for accredited kind of keeps us with the people that we know that we never, ever want to lose money. It's super important to us. But if we do, it's not going to destroy them financially, So that's kind of our ideal person.
Okay.
We deal with a lot of business owners and a lot of people that have sole businesses. Those are the people that, and professionals that are high income earners as well. But we deal with a lot of business owners because a lot of them are trying to diversify their income stream out of their business because they see it as risky because it could go up or down. They do, And the people that have sole businesses that come into some money and they're like, hey, I don't know what to do with this. All I know how to do is make money in business, but I don't want to take business risk anymore. And we can help those people convert it into some of these real estate deals that produce the income without as much risk as business.
Perfect.
Yeah.
So for the people that or like myself, who I am absolutely not an accredited investor. I am confident on that. The best advice, I guess, if you were to give it to me, would be to stay literally in my lane, for one, and do the traditional things. So like, obviously 401k is pretty simple, but like the retail stock market area is like the best play, or like get a financial advisor and have that taken care of in that sense.
Don't try to beat the market is my advice.
Yeah.
Is invest consistently over time and don't try to beat the market if it's not what you do every day. Most people are best served by earning more money wherever they're at and being wise with it and saving dollars to invest. That's the most applicable application for people is doing that. But secondly is like, don't be the stock picker. Get this. This is a mind-blowing statistic. Okay. 94, say that again.
94, yeah.
94% of mutual funds do not beat the S&P 500 index.
Okay.
So these are actively managed funds by people who are like, they literally went to Harvard and Yale and all these places to manage money most of the time. And you're paying them a high fee to manage the money. 94% of them don't beat the S&P 500 index. So investing in a low-cost index fund where you're getting broad diversification across America's 500 top companies is a super wise choice to select in your 401k if you can. You know, you can select those inside of there sometimes. Or if you're just investing through a private account, you know, a regular trade account, going into the S&P is a super, super wise play. And like, that's what I would advise is like, store the money there and keep putting it in little by little. Proverbs 13:11 says that we grow wealth little by little, right? So storing it up little by little there is the way to build it. And then once you have a pile, then you can decide where to go with it. But that is what I would advise to somebody, just like, hey, do something that's low cost and that you can do regularly. And over time is your best friend.
Yeah. So in putting it in comparison to the accredited investor who has $100,000, that's not going to hurt that person.
Yep.
The person that's not accredited, you know, $100 here and there putting into the S&P would be typically fine.
Yeah, I love the numbers, Ben. You know that I could get in all these weeds, but like, I just want to give some perspective for somebody listening to this right now that maybe is like, all right, well, like, does this really matter? Here's the thing. If you save $250 a month, and most people can shave that out of their budget from eating out and getting caught. If you invest that money into the S&P 500 index and you started doing that and you did that for 40 years, right? Just every month, $250, that is $1 million at retirement. So $250 a month equals $1 million at retirement. If you do $1,000 a month, that's $4 million at retirement, little by little. So it seems small at the beginning, and it is, but having it in the market for a long period of time, the compounding effect is it's incredible. And we don't think that way. We think linearly. So it's hard for us to wrap our minds around that. But it's like, now I kind of like, I heard this number the other day. I'm like, oh man. So I'm like, I go to spend something and I'm like, man, this is my $1 million. It's $1 million extra at retirement. I'm not going to buy the thing, right? And it's an easy filter to keep you from, you know, what most people are doing is just buying things that they don't need to impress people that they don't like.
Right. Perfect analogy for sure. Man, this is I feel like there's so many directions I could have gone with this episode, and there are a lot of questions that I didn't even get to fully touch on, but it's really interesting to know, because I was always curious. I would see you posting, and you had an office right next door for a while, and I would hear, not that I was trying to hear, but I would hear you talking, because you and I both have loud voices.
Yes.
And I'm like, man, it sounds like there's like some crazy deals happening on next door right here. So I've always wanted to have you in and to talk about all the different things that you're involved in, because I knew that you were a real estate agent at one point.
Yep.
And then I knew through the mastermind meetings that Nathaniel Moore had back in the day, back in 2018. God, I miss those days, pre-COVID. Those days were interesting because we all had moments where we could share different things that we were doing and like struggles and then wins. And I would hear some of your stuff, and it just crazy to see where you are now, especially in real estate, like the progression of it. And it's wild to see that you've repositioned yourself in real estate where you're no longer worrying about toilets. You're worrying about other people's money. That's a fascinating progression of your career. So I want to leave off asking you this, because we're all just over an hour, is what is next for you? I mean, obviously, So Capital Partners is a thing that you guys are just getting rolling really good. Where do you see yourself in 5-10 years? Like, do you see yourself sticking with this? Is this something that's for the long haul? Because obviously you said some accounts, money is tied up for 4 to 6 years.
Yep.
It sounds like you're going to be this for a while. Like, what does that look like for you?
Yeah. So I'll give you two answers, right? I'll give you the business plan answer, and I'll give you the reason why I do all this stuff and the hard answer, right?
Perfect.
So the business plan answer is yes, we plan to grow this. We plan to grow our assets under management to $100 million. So that's our goal. Ideally, we would do that in 5 years. That's fairly aggressive. It can definitely be done, but so that's the goal, is to have $100 million of assets under management of people's money that we're stewarding.
Okay.
And so, and just doing more of the same, right? Most of the time, the answer is just do more of what you're already doing more of the same.
Yep.
Because the relationships compound. Most of our business comes from referrals from people and people that's already done business with us. So the more those people we help, that just grows on its own, right? And if you grow people's money from 1 million to 2 million, you don't have to raise any more money. You already seeded your next round of investment from the person's money you doubled, right? So that's kind of the plan for us with So Capital Partners. The why project for us, and like what we're really trying to do, is we see that there's an opportunity in the marketplace, and we're just kind of like, we've been talking about this for months now and just trying to figure out how it works, but that there's a better way to operate giving. There's a better generosity model that exists, and most people don't know about it. But the generosity model of helping nonprofits and churches and these organizations that are always raising money, we want to help them be better stewards of that. And there's a way to do it through what's called a donor advised fund, where basically you can invest the money into the donor advised fund, and that's a charitable donation. But then you can wait and invest that money or give it at a later date. So, simple example, you want to give $50,000 to your local church. It's the end of the year. We got 10 days left, right? You want to get the tax benefit this year, and you have nowhere else to give. You're like, all right, I'm just going to write a $50,000 check to the church. Poof. Okay. That money is gone. The church is going to get it. They're going to do whatever mission they have for it. And that money is, or, name the charity, right? That money is never going to be seen again.
Right.
Okay. There's another option where you can go into the donor advised fund, and the donor advised fund has certain areas where you can make the investment. So the donor advised fund buys you time and flexibility. So you write the check into the donor advised fund, you get the tax break this year, but the money can just stay in there. You don't have to give it right away. So it gives you time where you can give the money at a later date, where you're not feeling the pressure. You get the tax write-off in this year, but you're not feeling the pressure to go and make a decision at the end of the year when your CPA tells you how much tax burden you have, right? The second piece of that is you can actually take that money and invest it. So let's say we take that $50,000 and we put it into a debt fund that produces 10% a year. Okay, so that means that now we have $5,000 a year that can of income that comes off of that $50,000. That instead of the charity getting the $50,000 one time, they can now get the $5,000 every single year.
Okay,
and as long as that money's parked and generating a return, it can perpetually generate income for the charity. And so if we get we keep raising money and we get into the donor advised fund and we get the pool bigger and bigger, we're protecting the principal and we're living off the interest, right? Yeah. We're basically making potentially making these charitable organizations financially free, right? By investing the money and them living off of the interest is essentially what would happen. It just takes a little while on the front end. So that's kind of our passion part. We haven't got all the details squared away yet. And we haven't launched the first one yet, but that is kind of the heart of what we want to do is we want to be able to use the gifts that we have and the talents in real estate to help these organizations have more money and be more generous and help individuals be more generous to the organizations that they want to by just making wiser choices with the money. So,
wow.
Yeah.
Okay.
so that's the long-term plan is we're going to give a ton of money away, dude.
Dude,
Yeah.
I love it. I love it. Sounds like a plan. Man, this has been a very informational heavy episode. A lot to take in. And there's still so much that I think that we could have touched on. There were some things in there that I was going to ask, but the way the conversation went didn't need to be asked. For example, I was going to ask as a pretty much a landlord, is that you were at some point.
Oh yeah, still am. I still own
Okay.
148 doors that I am the active operator of.
Wow. Okay.
Yeah.
So maybe this is a relevant question, and we can close out after this. Is that the general public has this thought about landlords and like doing, slapping the landlord special on the walls
yeah.
during renovations, and you'll see on the internet, pictures of wall outlets painted over and everything like that. Is that the norm, or is that like the bad apples? Like, well, how would you describe yourself as a landlord if you can be honest about it?
Yeah. So I like to produce a product for the market that is a product market fit, right? So it's like we always want to be a little bit nicer than what the standard is, but like we don't want to go overboard because it is a business that we're running for profit. Like we are taking a risk with our capital, so we want to get a return for that money.
Yeah.
And so we do that by making profit, right? So we don't want to spend money frivolously, but we also don't want to make it dangerous and uninhabitable. It's just like everything else, dude. What sells is the messy, like crazy stories. I know a friend personally who had a 32 unit in Lafayette, and dude, they were way over renovated. These apartments were way, way nicer than they should ever be for the amount of rent that they were getting. No one tells those stories of the landlords who over renovate and overdo it and make it way nicer than what the tenant's paying for.
Right.
Right?
Yeah.
So the negative stories are popular to tell,
Yep.
but there's just as many people that make theirs nicer than what the rent calls for. And so there's a spectrum, just like everything else. It's like there's people that way overdo it. There's people that way underdo it. We kind of are right in the middle where like we want to renovate and we want it to be what the market expects for that and what's a fair trade for their rent dollars for the product that they're buying essentially. So we try to stay a little bit on the nice side, but not too much that we're just hemorrhaging money for no reason.
Yeah. Great answer, man. Great
Yeah.
answer. And I'm glad you're in the middle to above place, because there's some of those negative images, man. That, like you said, it's a spectrum. It's wild. But like you're right, you don't see the ones where they're like super, super nice and for no reason. And
Yeah.
the rent is not that bad.
No, they got granite countertops in $700 apartments in some places in Lafayette. And
Wow.
yeah, it's like this does not justify the $700 a month of rent,
Right.
But those exist. Just no one's talking about that.
No.
Like no one's like, hey, look how nice my landlord made this, because that's
No
not
one-
fun.
yeah.
It's like I deserve this, right? It's like,
Yeah.
well, the market doesn't say so, but you're lucky you have a super nice landlord.
Yeah.
So
Crazy stuff, man. All right. Well, so how can people find out about you? How can they reach you if they want to? If they're listening and they are an accredited investor, how can they reach you and what? Yeah.
Yeah, I appreciate that. Yeah. If you're a accredited investor or you just want to learn about this, you can go to investwithsocapital.com, investwithsocapital.com, and you can find out more about the company there. But if you would like to connect directly, you guys, I'm going to give out my cell phone here. You guys can bomb me. I love it. 337-257-7102. So just send me a text, give me a call, and we can figure out what that plan looks like for you and your real estate investments.
All right. Well, yeah, man. And like I said, or like you said, the website is investwithsocapital.com. All right. I think I put the right website in the caption. If not, I will go correct that. But the website should be in the caption. And with that, man, Logan, it was great to have you on. What an earful this has been. And
I hope I wasn't too overwhelming with all of my jargon, Ben.
look, I mean, I'll be honest. It felt a little bit overwhelming, but you know what? That's the world you live in, and so I think it's great. I'm pretty sure there's times where I'll talk to people about what I do, and they're like, huh? So I know a little, like I understand a little bit about what you were talking about, but for the most part, I equated it with things that I understood and were on my level. Because, like I said, I'm not accredited investor. All right.
Yes. Not an accredited investor yet.
Yes. Yet. Oh gosh. All right. So that's it. This is the episode. Logan, thank you for coming on, man.
No, man. Thank you for having me.
All right, guys, and that's it. I hope you have a great weekend, and it is the weekend before Christmas. So do take care of yourself. Have a Merry Christmas and a Happy New Year. We'll see you before the New Year, but stay safe out there because the traffic is wild. If you're driving around in Lafayette right now, be patient. I would say use a back road. I really don't want you using the back roads because I like those back roads for myself. But Ambassador, y'all be careful. There's a lot of accidents happening, and we don't want accidents right before Christmas. So again, Logan, thank you for coming on, and we'll see you on the next one.